Hello and welcome to KX's introductory course on quantitative trading. My name is Andrew and I will be walking you through the material we have prepared. Our aim is to give a basic introduction and demystify some core concepts. So let's start with the definition of quant trading. So quant trading, which is short for quantitative trading, is a style of trading that relies on mathematical models, statistical analysis, and computer algorithms to decide when to buy or sell financial instruments such as stocks, futures, options, or currencies. Jim Simons, who was one of the early pioneers of quantitative trading, reflecting on the birth of the industry, said, "I looked at the price charts and analyzed them. They didn't look random to me. They looked kind of random, but not completely random. I felt there had to be some anomalies in this data which could be exploited." This brings us to a key concept of randomness or noise in financial time series data. The noise in these financial time series is so great that finding the anomalies is often compared to finding a needle in a haystack. The search for this alpha has become increasingly difficult as the quant trading industry has grown ultra-competitive. Now massive volumes of data need to be processed using increasingly sophisticated methods. When I started out in quant trading, somebody once told me that the R-squared in physics is close to 1. The R-squared in astrophysics is close to 0.1, whereas the R-squared in quantitative finance is close to 0.01. So there's an order of magnitude difference in terms of the statistical errors that we encounter in quantitative trading. So if you're someone who loves certainty and knowing things absolutely, then quantitative trading is maybe not for you. So the next thing I want to do is just to give you a brief understanding of the two different types of institutions that exist, and these are traditionally called the buy side and the sell side. So quantitative traders were traditionally divided into two camps. Buy side traders invest capital to generate a return, for example hedge funds. So they're risk takers who buy things that they think are going to increase in value and sell things they think are going to decrease in value, taking risk in the market. And sell-side traders facilitate trading by offering two-way prices. So they offer a price at which you can buy and a price at which you can sell. And the difference in this accounts for a small margin, where they try to manage that risk to their business. Historically, the sell side was dominated by large institutional investment banks, but more recently, more liquidity has been provided by non-bank players. Another good way to partition the quant trading landscape on the buy side is in terms of how long an investor will hold a position. There's a lot of variation in strategies and technology between a macro hedge fund that turns over a position once a quarter and an ultra-high frequency trader that profits from split-second anomalies. In terms of roles and responsibilities for a quant, I've tried to divide it up into three main things. So there's pricing, there's hedging, and there's execution. So pricing involves understanding the price of assets and forecasting their movement. Building a price that leads the market is key to building a competitive business. It allows market makers to contract spreads and attract more flow, whereas on the buy side, predictive analytics is the cornerstone of making good trading decisions. Building a price that is ahead of the competition requires high quality data and expert modeling. The second role and responsibility for a quant is hedging. This involves risk management of a trader's portfolio based on risk models. Over the course of a firm's trading window, markets may become volatile, and on the sell side, counterparties may load the firm with toxic positions. There must be decisions made about what is a tolerable amount of risk that a firm can manage and how to liquidate such positions. And finally, the final role I want to discuss is execution. This involves understanding market impact to keep trading costs low. Here we focus on the execution of the trades, so actually deploying the trades. There are many possible trading venues offering different sources of liquidity. Trading on these venues will create market impact that will potentially disadvantage future trades. The proper location and timing of trades can have a big impact on the efficiency of a firm. How each of these roles will look will vary a lot based on whether it is buy-side or sell-side trading and the frequency at which the trading is taking place. So just to finish, I'm going to give you an outline of what we're going to cover in the course so you know what's coming up. So the first thing we're going to discuss is Sharpe ratio and turnover. So these are the fundamental metrics that hedge funds target to assess the quality of trading strategies. So we need to know what is the benchmark that we're going to use to evaluate our trading strategies. Then I'm going to look briefly at futures contracts. So futures contracts are used by hedge funds to gain leverage and exposure to many different assets, and they're a very efficient way to trade. So we're going to discuss futures contracts, and the rest of the examples throughout the course will focus on this type of contract and this instrument. Then I'm going to give a brief introduction to momentum trading and explain trend following strategies. So these are one of the most popular trading strategies for trading futures contracts. Then we're going to look at volatility scaling, how risk is managed within a trading strategy. Then we're going to see a very important concept, which is the concept of diversification, and look at how portfolio diversification is important for boosting Sharpe ratio. Then we're going to look at some other trading signals. We're going to have a section on risk management and how you would assess the risk to your business. And finally, we'll look at machine learning as a means of generating new and interesting signals for trading. So that's it. Thanks very much, and we'll see you in the next chapter.